This is Tom Nunamaker with Capital Discussions. This is my trading update for July 25th, 2014, the day before my wife's birthday. So, this is Friday into the week. We're looking at ES futures, and this is 2 days, so Thursday, Friday. You can see overnight it was kind of quiet, went up a little bit, and then started selling off, came up, and then near the open started coming down again. And that's about what happened with SPX. You can see it opened lower, stayed, in the same region, sold off, came back, sold off, tried to come back, sold off. It's kind of this same story over and over today. Net for the day, let's see, ES was down 975 to 1971, and SPX was down 985 to 1978.13. So the VIX futures, they are all going up, so they're all in contango. So no real fear in the market. It's just some profit taking on a Friday. So let's take a look at my trades. For the ES, in option view, if you click on these column titles, you limit the trade details down at the bottom and the charts to just that trade. So if I unclick it, I've got the combine. So here's we have our vertical spread that I bought for $18, sold for $18.25 for a net 25% credit. So there's no risk on the trade, margins basically zero, and the analyzed chart shows that. So we're right now, pretty good chance it could actually keep going down, and if it does, that'll help, make another $500 on the downside. I did put this trade on today, and we're up about $150, $167. It's a futures options trade, broken wing butterfly, similar to the SPX trade. I did an 8 lot, and then I added 2 vertical spreads. If you take these out, you can see what the spread looks like without the verticals. Looks like this. Now let's check the volatility. At the money vol is 10, so we'll just put 11 again. Just put it 1 point higher, just in case it keeps moving lower and vols go up. That'll account for that a little bit. If we look at the expiration line, 85% chance of making money according to option view. It's not bad, but no, the risk is like 15,000, so it's not too bad. And the reason an SPX index trade, an 8 lot would be over 30,000, while the ES is $50 a point. So it's kind of like a half size SPX trade, if you will. And the nice thing with futures options is that it's span margin, so it's always risk-based margin. You don't have to have $100,000 in your account for a portfolio margin account. You can have a $20,000 account with futures and get risk-based margin with the futures. Now, another nice thing is you can actually buy and sell the futures. So you can buy and sell the underlying, and it trades 24 hours. So if there's some world event, like while the US market is closed during the week, the futures and the futures options are open, so you can actually start adjusting your trade, any hour of the day almost. Now, there is a problem with that, is that, if you'd like to sleep, then you should put in some contingent orders if you're worried about it. Like on the futures, really to hedge yourself, it's easy. They're very liquid, get filled very fast, and the slippage is very, very tight on it. So if you look at the ES futures, for instance, bid 1970.75, ask 1971, so 25 cents for the bid-ask spread, and that's constant. You'll always see that for the futures. I don't think I've ever really seen it different than that, because it's so liquid. Here, let me, before I leave that, now the U.S. market is already closed, and there's 500 and 281 contracts bid on both sides. They're still trading. So even though the U.S. market's closed, you can still trade the futures, which is kind of nice. So without these 2 contracts, we had about 15,000 of margin, and the risk graph looks okay. It's slightly, we have to use the both, 33 delta. So I wanted to flatten that a little bit and get rid of some of the Vega. So I actually did 2 credit spreads. debit spread, sorry. I bought two of the 1950s, sold two of the 1930s. So that gave me this, 10 cell 18 by 8. And then the risk graph looks like that. So if we zoom in a little bit, and we can also zoom by click dragging this way. And now I superimpose with the extra puts and without the debit spreads. You can see that we give up a little bit of profit. So here was the original trade. We would make $1,100 at expiration above the upper strike. And on the other one with the debit spreads, it's $691. So what's that, about $420 to do those two spreads? And does that make sense? Let's see. Yeah, so 1123 from 1549 is a little over $4. So that's about right for the math, because remember, $50 a point. So if we superimpose that, you can see the blue line is with the debit spreads added, so it gives us a nice lift if we keep moving down, and we just give up a little bit on the upside, but the yields are still pretty good. So if you look at it, 691, let's look at 691 divided by, what's our margin? Well, if you look, right now the margin is 56.71. Is that what we should use? Probably not, because that's risk-based margin. If we want to be conservative, we'd use Reg T, and it's about $13,000. So why did that be reduced to $2,000? Because the debit spreads can give us some extra cash if we keep going down. So it reduces our loss, reduces our margin. So if we take 691 divided by 13,000, that's about a 5.3% return for this part of the graph right here at 691, which is a pretty good return. You know, if you're if the market rallies, we have no risk, get a 5% return on our Reg T margin. That's not bad. So this is, you know, we're looking pretty good even with this volatility where it is. If we go on the T plus 10 line, remember right clicking will give us the date. So that's August 4th. That gives us a 97% chance of making some money, and we might be just happy with that. If you zoom in, you can see that the T plus 10 is kind of at the expiration profit right in this area. So you could just exit and call it a day. If you think it's going to sell off a little bit, you know, you could wait till the next line, T plus 19, which is August 13th, and try and get a little bit more out of it. You know, if you had up here $1,500 to $2,000 on 13,000 of margin is a pretty nice return. So we're giving that a try. It looks pretty good, and the trade's looking fine. Delta is a little bit long delta, low gamma. You have some theta, not too much vega, but you can see just visually it's very flat, and that's what we want. And if we look 10 days from now, we have a pretty good range where we can make money. And even if the markets keep selling off a little bit, it's still going to be fine. You know, so we're just watch it. As long as we don't have a huge meltdown, like we're down 40 points, then we have to get aggressive on defending it. We can just start buying futures. That's the quick and easy way. And you could actually set that up as a contingent order too. So now we have, we can use our previous next button in option view because we have a group set up. So now I'll go to the SPX. Again, it's going to have a similar chart as the ES futures. We have, here's our options, the original price, current market price, that's the mid price between the bid and the ask. Up about $400, so we gave up $200-300 of profit today, but our delta's a little positive, still good theta, not too bad on the Vega. If we look at the chart, so I like to look at these visually. When you zoom in, you can see it's bending down a little bit, but if let's just go to Monday. So today's Friday, so I'll go 3 trading days from now, or 3 calendar days, so July 28th. This is what Monday should look like. So pretty good. We have to go, if I show the break evens, that's all the way down to 1940. So you'd have to go down 27 points almost with no volatility change, obviously, for the break even. If we do want to pump the vol up, say 1.5 points, then our break even goes to 1957. And you see how it jumped up there? Because it's pushing these lines down. So in option view, you can actually do pretty fine control on this. So you could do 1.6. See, it's just small changes. 1.7. Push it down just a little bit more. And if you want to, again, zoom in and see where that ball is. Oh, I move it over. Okay, so right now this line is not going through the black dot. Now the black dot is called the Graham dot after Jim Graham. That shows reality, and the rest of the graph is theoretical. So they kind of merge, but they don't always line up. So you'll see the volatility, the T+0 line for this is 1.7. Well, I want to move this up, so the easy way is just to adjust this volatility until the line goes right through that dot. So that helped a little bit. Let me see what 1.5 does. It's a little bit too much. Maybe 1.55. Yeah, there we go. So 1.55 goes right through the center of the dot. So that's pretty close to what option views reality versus the theoretical is. So if we use that, then 1958, so we have 20 points on the downside on Monday, which is more than one standard deviation. So that would be a pretty big move, and we would still be pretty good shape. You know, we'd be at break even. We're not really losing much. So all in all, the trade's looking pretty good. So we'll just steady as she goes at this point, and keep these flat T+0 lines with some positive theta, and try and make a little money. And if the market gets aggressive on the downside, we'll get aggressive defending it. So that's pretty much it. We're going to have a market analysis tomorrow with Jim Riggio and a few other people that have said they want to join us. So I'll get the instructions out to those folks, and we'll hopefully see you tomorrow morning. And if you're not joining us tomorrow, you'll see the replay, and have a great weekend otherwise, and we'll see you next week for good trading. Thanks. Bye.